Hello, everyone. I'm Yahya.
I'm Alex.
I'm Rhythmic.
And I'm Shora.
When the COVID-19 pandemic began in March 2020, it led to many sudden changes in the economy. Unemployment skyrocketed and the GDP tanked. In the last 2 years, however, the economy has bounced back and we have recovered in many aspects. For example, unemployment has stabilized and many more people are working again. As expected, however, the Phillips curve shows that a decrease in unemployment leads to an increase in inflation, and as we move from long-term equilibrium to an inflationary gap. Furthermore, other problems persist in the current economy that my team and I will now break down on a smaller scale.
Rural residents are outpacing their urban counterparts in inflation. Over the past 2 years, rural households have experienced 18.5% inflation, while urban residents have experienced 14.5% inflation.
When comparing different racial groups, we can see that from pre-pandemic levels, Black and Hispanic workers experienced small increases in real earnings. This was due to the increase in the GDP and output the country was experiencing before March 2020. However, after the pandemic, real weekly earnings have been declining in the past year for all racial groups, including Blacks and Hispanics. This can be seen in the average weekly earnings, which went from $1,100 in June of 2020 to around $1,000 in June of 2022. Additionally, Blacks and Hispanics were employed below the national average. However, that gap has narrowed and their employment rate seems to be matching the rest of the country as we move away from the pandemic. On the other hand, they're experiencing higher rates of inflation, much more compared to their white and Asian counterparts. This is because more of their income goes towards expenses that fluctuate more in price, like gas and energy. Additionally, higher income families share the luxury of spending their money on lower end products when prices increase, but low income families do not have that sort of wiggle room, which means that they're affected by inflation more. When comparing different age groups, we can see that a disparity exists between generations of Americans. Inflation after the pandemic was felt much harder by younger generations, and this is reflected in the amount they spent on expenses. The age groups for people under 25 and people from 25 to 54 spent more money on housing and transportation compared to their American counterparts who are over 54. Furthermore, when comparing the inflation percentage for age groups, we can see older ones fared much better throughout the pandemic. In the long term, this means that younger generations who were once catching up to older Americans in terms of real wealth have fallen back again.
When looking at the current economic condition, one thing we should address is who gains more, borrowers or lenders. One thing to look at when looking at this is the Fed has been increasing interest rates, which will ultimately increase the cost of some loans. This benefits the lenders more than it benefits the borrowers, as the borrowers who take out the loans will have to pay back more money ultimately at the end of the loan than the amount of the loan that they took out. Additionally, short-term borrowing rates, specifically on credit cards, are heading higher and continue to increase. The graph shown on the right indicates that at the end of 2020 and the beginning of 2021, interest rates were decreasing at a constant rate, but ever since the end of 2021 and till 2022 and now, the interest rates have been increasing rapidly and they will continue to increase in the near future. Forecast of the near-term economic and financial conditions, the average 30-year fixed home mortgage rate is now above 4% and is likely to keep climbing. The graph below illustrates how the 30-year home mortgage rate was decreasing constantly, but recently it's been rapidly increasing and it will continue to increase for the near future. And any future home buyers should consider this when looking to purchase a home. Additionally, car buyers taking out loans for a new vehicle borrowed an average of just under $40,000 in 2021, which is an increase of over $4,000 from just the year before. This number is even higher now in 2022 and will continue to rise in the near future.
In 2020, about 82% of rural wages went towards expenses. Now, those expenses consume 91% of rural take-home wages. Because rural households have lower incomes, household expenditures make up a greater share of income, leaving less discretionary dollars. Discretionary dollars are decreased by half in rural areas, but only 13% in urban areas. Coupled with the cost of goods and services, the narrower spending margin caused many to think twice before making a purchase. Moreover, many rural families do not have extra money to cover emergency expenses and unexpected bills. Not having this extra financial cushion puts families in a greater risk for increased debt and potential bankruptcy. Along with that, the purchasing power of the consumer dollar has fallen from 3.20 of the last year to 36.20 to 33.60 on the consumer price index. This often leads to higher cost of living, higher interest rates that affect the global market, and falling credit rates like we're seeing right now in the US economy.
So now that my team has presented some of the information relevant to the current economic conditions, as well as future forecasts, we can begin to advise the Fed to make some kinds of monetary policy recommendations. So to begin with, we can take a look at the Fed's past behavior and conjecture that this might be relevant in the future. So taken from the recent Fed report released over the summer, we see that they note that the Federal Open Market Committee has swiftly raised the target range for the federal fund rates and anticipates that ongoing increases in the target range will be appropriate. Increasing federal fund rates will lower the money supply or decrease the money supply, and therefore cut aggregate demand and consumer spending, thereby, in theory, aiding a reduction in inflation. Coupled with this idea, we suggest that the Fed continues to sell securities, treasury securities, as well as bonds, in order to raise administered interest rates. Raising administered interest rates will make borrowing more expensive, which should, in theory, reduce demand after nearly a decade of ultra-low interest rates spurred on by the Great Recession during 2008 and 2009. And so as we can kind of see from the two previous slides, those two ideas, in tandem with this is that if the Fed continues to raise the discount rate, meaning the interest rate that they charge their member banks, the overall money supply will decrease, in theory, decreasing aggregate demand and consumer spending. And we can see that the Fed has already began to implement this sort of strategy, and that we can see that past the recession, indicated in the gray bar in the graph below, we see that that the data shows that the Fed has continued to sharply increase discount rates in a move to reduce inflation in the United States economy. Okay, so given those things, we would expect that the Fed should continue to do those actions, and that would lead to some results. And we can already see that in some cases, some indicators that have been used by market economists tell us that inflation has already began to subside. So we note that the Fed is strongly committed to returning inflation to its 2% objective in the aspect of retaining price stability for the American consumer. But we do see that some indicators, for instance, depicted below, the 5-year break-even inflation rate, which is a widely used metric that that predicts how the market views expected inflation, has shown that expected inflation has already began falling, and in fact began falling well into the spring, near March or April of 2022. And so coupled with this idea, right, that what are the actions that the Fed needs to take, we can see that another issue is that there are some economic indicators that are what economists refer to as lagging indicators, right? And so one of the classic examples is rent. And so in the formulation or the calculation for the consumer price index, or the CPI, rent takes up about 1/3 of the CPI calculation, but it does include renters' leases that are fairly recent. but it also includes renters' leases that vary in their calculations. And a team of economists from Goldman Sachs calculated that this lag averages about a year. And so what that essentially means that this analysis recently found is that the consumer price index therefore reflects conditions in the housing market in late 2021, when rents were rising at a double-digit rate, and not conditions today. And so we know from that analysis that Goldman Sachs projects an annualized growth rate of only 3% in the third quarter of 2022. And so what this means is that because the CPI retains rent, which is a lagging indicator, it's artificially higher than what we would expect it to be using data calculated within the last 2 quarters of data. And we can actually see that from this analysis that's plotted at the bottom of the slide, the gray area, which indicates future activity in 2023 and 2024 pertaining to rent inflation. We can see that rental inflation has already began subsiding in this year. And we note that there was a sharp spike in 2021. And so we can see that the Fed's actions to a certain degree have already began dropping inflation. And so what this means is that further action to reduce inflation by raising interest rates could further reduce rent's contribution to inflation. And this idea, or this hypothesis of sorts, is backed up by the Sticky Price Consumer Index, which notes items not including food and energy, which are noted to be volatile, but rather items that don't tend to vary very heavily in terms of price. And we note that there do tend to be long lags between policy changes, such as those enacted by the Fed, and reported inflation-relevant metrics, like the CPI. And as we know, the sticky price CPI has risen quite sharply over the last 18 months to 2 years. But we do see in the last 2 to 3 months, denoted near the September 2022 ticker mark, that inflation the CPI has began subsiding, even though the CPI is a lagging indicator, which means that the true measure of inflation has begun subsiding well before September. So as such, with the information that my team has presented in the previous slides, we have some monetary policy recommendations for the Fed. Given the high core inflation metrics, with inflation well near double-digit rates, we still propose that the Fed continues to implement measures decreasing the money supply. And this includes standard measures like raising administered interest rates and engaging in open market operations, such as the selling of treasury bonds and securities. But the biggest thing that we would like the Fed to take care of or to note is the very real possibility of an economic recession. And we note that the rental market highlighted in the slides before and the housing market are a kind of an indicator or a foreshadowing of economic recession. In our opinions, we suggest to the Fed that they slow down rate increases in future meetings in order for the economy and consumers to adjust to more expensive borrowing patterns and to avoid the very real possibility of economic recession. One of the things that's gone really well for the United States economy over the past 2 years is a near half-century low unemployment rate. And raising interest rates would most likely induce higher unemployment, putting millions of Americans out of jobs at a time of already high inflation. We do note furthermore that, as illustrated a little bit earlier, there are some indicators that inflation has already began to subside, with the rental market being a clear indicator of this. We still suggest that the Fed increase interest rates because activity has shown that consumer demand and spending has still continued to rise, even with higher prices. But we do think that the Fed should slow down these rate increases in order for the economy and for economists to understand what is really going on, as opposed to the artificiality of the economic view presented by lagging indicators like the CPI, all in order to avoid the very real possibility of an economic recession or worse, a depression. Thank you so much for listening to our presentation.